accounting. So we're going to continue along the lines of our discussion last week, but today we're going to talk about activity-based costing. Because remember, last time we spent a good portion of the class discussing the differences between different costs, and we said how important it is to be able to classify those costs and understand cost behaviors. Does that sound familiar to anybody? Yep. That over here? Good, good. So that's our ongoing challenge, is how do we address the costs that we have in a way that's meaningful to us as managers and executives and business people. Because what we're going to be talking about today is overhead, and the way that we're going to apply overhead is through this method known as activity-based costing. So at one time, a lot of emphasis was placed on direct labor. And direct labor was used as an allocation base. And in some cases, that could be very appropriate. But in many manufacturing facilities, the use of labor has decreased, and manufacturing systems are more and more automated than they were previously. And not all overhead is tied directly to the amount or the number of hours that laborers are expending. So if we have a manufacturing facility that makes 6 different products, and we have manufacturing overhead, that's a very complex organization that really doesn't lend itself to using direct labor in most cases, right? That's a generalization. It depends on a specific organization. And we're going to talk today about different activities, different measures, different cost pools. And then you're going to see, based on the range of cost pools, that depending on the organization, there could very well be different ways to allocate manufacturing overhead. Because ultimately what we're trying to find out is, what is the cost to make a particular product? And it always, at first glance, it always seems very simple, and we think that it's something that we should know. How much does it cost to produce our product? And we said, well, we know what our direct material costs are, so we know what the cost of the plastic is, or the cotton, or the wood, whatever it is that we use to make the product. And generally, we have a pretty good way of tracking the number of hours that laborers spend assembling the product, producing the product. But then we have that indirect material and that indirect labor cost, which we call manufacturing overhead. And that's the part that we struggle with, but we need to understand that. And we have to have a way to apply those manufacturing overhead costs so that we could determine the profitability of the product. And the only way that we could determine what we should price the product at so we are profitable is if we know what it costs us to make the product. So we have to start with our cost. Once we know what it costs us, then we could determine a price. So there's no way that you could set a price that you're going to sell the product and be profitable if you don't know what it costs you. We want to be able to make fact-based decisions. So we need to know the cost. But there's some costs that we said that are easily traced back to the production of a particular product. We said those are direct costs. The indirect costs are the costs that are more difficult to trace back to a particular product. Like, for example, the salary that we pay the plant manager. Well, how do we know? What percentage of the plant manager's salary should we allocate to product A, to product B, to product C, to product D? And what about the people that we employ to clean the manufacturing facility? Do some products create more of a mess in the manufacturing facility than another? So in a given manufacturing facility, we might have these 6 products that are very different from each other. It doesn't mean that it's a process costing system. It could be, we talked about job order costing, where we could, in a given factory, regardless of whether it's process costing or job order costing, we could be making 6 very different products. And in some cases, the machine hours might be relevant. But maybe the product line that Yusuf is in charge of runs a machine, and that's a significant part of the cost. But maybe the product that Jason is making in the factory doesn't have a machine that it's running extensively, or maybe not at all. Maybe what Jason is making is very labor intensive. So how could we say, if we say we're going to use machine hours as an allocation base, that means that Jason wouldn't get any allocation of the cost for janitors in the facility, and Yusuf is going to get a disproportionate amount. So that's what we're going to try and resolve today. Sometimes we use departmental overhead rates, like for example the machining department and the assembly department and the shipping department. All of those could be departments in an organization, but those also have the same issues. And that's why activity-based costing is ideal for those very reasons. So there's a number of allocation bases that are used for assigning costs to the products. All right, so some important terminology. The first is the activity cost pool. The second is the activity measure, and then the activity rate. So what do we mean when we say the activity cost pool? What we're talking about, for example, is the machine hours, the setup time, the number of production orders, the parts management pool, the general factory pool, even the labor pool. So all of these, whether it's the labor-related pool, the machine-related pool, the setup pool, all of those are cost pools. Those are activity cost pools. And within our organization, we have to decide which is going to be most relevant to us. Because then what we're going to do is we're going to look at the activity measure. So the activity measure is going to tell us how much of the activity is carried out and is used as the allocation base for applying the overhead cost. Because that's ultimately what we're trying to do, is to determine how much over the overhead to apply. Ultimately, what we're trying to determine is how much of the manufacturing overhead to apply. So what we're going to look at is different different activity pools. But it depends on the organization. So that's something as a manager that we have to decide. That's a judgment call on our part. You have to know your organization and know, is your organization labor intensive? Is it highly automated? And what we're going to do is we're going to determine the activity rate. So the reason why the activity rate is so compelling is because that allows us to do what-if analysis. So remember we talked a little bit about that last time. And what we're going to do is we're going to look at these different activity pools, and then what we're going to do is we're going to determine what is the activity rate either per hour, for example, or per setup, or per part. And then once we know that on a unit basis, then we could make some assumptions about different production volumes.
Is that why a lot of companies that start production outside the US is it the money that's basically?
Right, so what they're looking at, one of the things that's going to impact our make versus buy decision, so either we're going to make it ourselves or we're going to buy it from somebody else, is because we believe, and presumably it could be true, and in many cases it is, in many cases it does make sense to buy the product from another company outside the US. And the reason is because the manufacturing, well, certainly one of the reasons is that the manufacturing overhead is less. So the indirect labor and the indirect materials is going to be less. That's one of the things that we're going to compare. And that's why it's so important for us to know, well, what is our manufacturing overhead? Because until we know what that is, then we're not going to be in a position to compare a quote that we get from another company, whether it's in China or Poland or Russia or Yemen or Guyana. So we need to know what our costs are. Now, it very well may be that also the direct labor rate is less. Now, that's one of the things, sort of the low-hanging fruit, if you will, is that the expectation is that, well, in Detroit, laborers work for $30 an hour, and in China, some laborers work for $30 a month. So people think that it makes a lot of sense to source the product versus making it themselves. But it's not true in every case. It's certainly a significant phenomenon that's occurred because in many industries, there's no longer barriers to entry because you don't need to invest $1 billion into a manufacturing facility. You could source the product. You could have, this type of contract manufacturing. Somebody can make the product for us. Or maybe you already have manufacturing facilities, but still you realize that because of the high labor rate that you pay in the US, that would be much less expensive if you made it outside of the US. But manufacturing overhead is certainly very significant. And that's why we, in terms of our total manufacturing cost, why we address that specifically, even though those items are difficult to trace to a particular product. So difficult to trace and say, well, this is, 25% of this manufacturing overhead is for Jason's product line, and 38% is for Yusuf's product line, and 21% is for Benita's product line. It doesn't mean just because it's difficult for us to trace it back that it's not a significant cost. It is. Very often the manufacturing overhead is very significant. And that's why we need to talk about, now that we have this very significant cost, how are we going to allocate it? Is 72% going to go to Matilda's product line? I don't know, it depends. Maybe that's appropriate. But some might argue, why don't we just give everybody 20%? Everybody's going to absorb 20% of the manufacturing overhead. Well, in that case, probably Matilda's going to be very happy about that. But then Joanna says, well, wait a minute, that's not really, no, that's not fair. I think that I should only be burdened with 8%. And Carrie says I should only be burdened with 4%. So let's talk more about that. We're going to take a look at an example. So let's take this example. What we're going to do is we're going to compute the applied overhead. So let me show you how we do that. We talked about the activity cost pool. So what I'm going to do is I'm going to, for this particular company, I'm going to list what they've identified as the activity cost pools. So they identified several here. The ones actually that we mentioned earlier. Labor-related, purchase orders, parts management, board etching, and general factoring. Those are the activity cost pools. Then we have the expected level of activity. Let me see what that is. Expected level of activity. So in terms of labor, we're going to look at direct labor hours. Purchase orders, we're going to look at the number of purchase orders. We're going to look at the number of part types. The number of boards, and the number of machine hours. So here we're looking at direct labor hours, here we're looking at machine hours. And then we're going to find out what the activity rate is. So let's say this is A, this is B, and this is A divided by B. So here in this example, the expected level of activity is 40,000 direct labor hours. The number of purchase orders is 1,500. The number of part types is 400. The number of boards is 2,000. And the number of machine hours is 80,000. And actually, we need to put the estimated overhead. All right, so in this case, we've estimated this to be 280,000. Purchase orders is 90,000. That's the cost associated with 1,500 orders $120,000. Board etching is $360,000. And general factory is $400,000. So now we have enough information to determine the activity rate. And then with that activity rate, then we could determine the applied overhead. So what we're going to want to do as managers is a sensitivity analysis. We're going to want to look at 50,000 direct labor hours, 60,000 direct labor hours. What if it was 70,000 direct labor hours? Because we want to understand what is the cost. So we don't just say, all right, now we're going to start running the factory on the weekends. So maybe before you only operated 5 days a week. Now we decide, well, maybe we should open the factory 7 days a week. Well, we need facts to make that decision. So how are we going to make a decision like that if we don't know, for example, what the overhead is going to be? And remember, as managers, and we're talking about managerial accounting, we're not analyzing past performance, we're focusing on getting information to make decisions for the future. So we can't wait to find out, after we've been operating the factory 7 days a week, what the actual overhead is. We have to make some assumptions and use that information, use those assumptions to make decisions about whether or not it's going to make sense to operate the factory on the weekends. But in order for us to do that, we need to know, well, what is it going to cost us? So that's what we're going to calculate now. So the activity rate, the cost per direct labor hour at this organization is $7. So $7 per direct labor hour. Per purchase order is $60. $300 per part. $180 per board. And $5 per machine hour. So what we did was we took the estimated overhead and divided that by the expected level of activity. And that's how we got the activity rate. So what we've calculated just now is the activity rate. Now what we want to do is compute the manufacturing overhead cost that we're going to apply to production. So now that we have the activity rate, now what we want to do is look at the actual level of activity. So in this case, we're saying, not 40,000, 41,000 direct labor hours, 1,300 orders, 420 parts, and 82,000 machine hours. And what we need to do is multiply these two to get the applied overhead. You see why we have to calculate the applied overhead? Because this is only the estimated overhead based on this level of activity. Now we're looking at these activity levels. many companies, the companies that we want to source from, many of them have trouble determining the cost of their product. So when you get a cost to produce your product, think about, is it a reasonable cost reduction or is it too good to be true? That's it. Because many companies, and I'm telling you because I've been in a lot of factories in Asia, they have no idea what it costs them to produce the product. So if they don't know, you need to know what's reasonable. Because you want a partner that's going to be successful. You want to be successful and you want them to be successful. And ultimately, at some point, at the point of production, then they're going to know how much it actually costs them. And they're going to say, well, we can't, we had quoted you at $3.10, but actually, we're going to have to charge you $5.90 now. So then what? Then you're thinking, wow, I really should have paid attention in that class.
Can we retract? So we have an estimated overhead cost which we presume, right? We estimate that cost.
Right, that's based on information that we had previously.
From last month?
Yeah, it could be from last month or the prior period. It could be the last month or the last year.
But it's like a hypothetical, right? It's not
It's
actually what we're gonna get is something that we're thinking that we're gonna get, right?
This is based on information that we have, based on operating the process. But what we don't know is what's going to happen if we change the level of activity. That's what we're trying to figure out, to help us make decisions. So maybe everything is okay if we just stay at these levels of activity, but we're getting more orders, things are changing in the organization, we're going to have to produce more product. We've got distribution at some retailers that we didn't have before, and then the question is, well, what is our overhead going to be? How is that going to change? And then how do we apply that? How do we apply those costs? So maybe one of the things we need to decide is, well, are we going to hire an assistant manager? For example, well, how do we know all these things we need to take into account? We're not going to know whether or not we could afford to hire an assistant manager unless we know what our costs are going to be as we increase production. Because we know that our total revenue presumably is going to increase. Unless we lower the price, then then we'll have to see if we lower the price by how much our unit sales increase. But let's assume that total revenue increases by the incremental sales. So if our sales are increasing, then our costs are also increasing. And then we need to figure out, well, like we looked at when we did the schedule of cost of goods manufactured, we found, well, this is what it costs us to produce the product, and then we took that information to determine what is the cost of goods sold. So based on our sales, what was the cost of goods sold, which then we subtract to give us the gross margin, and then from that we subtract what? The selling, general, and administrative, which is our operating expense, the SG&A. So in this case, you see that the activity level has changed. That's what we want to
So
deal with.
that's the projected change that we might acquire, and we want to test for that projected change, right? Is the actual level of activity, right?
Right.
That's why it's different from the expected level of activity.
Absolutely.
And by calculating applied overhead, we're actually seeing what the outcome is going to be.
Right, so this is at this level of production, these number of labor hours, this is how much overhead we're going to apply, which in this case is going to be $287,000. Because remember, we have to apply the overhead. We're not going to wait to find out, well, how much was overhead that quarter. We have to use the information that we have. This is $78,000. This is $126,000. $387,000 and $410,000. Which is $1,288,000. How much is this? Which is the total, yeah. Anybody? Any grads do another calculator? How much?
1,050,000. Is that 120,000 or 20,000?
Yeah, this is 120,000. So here the number of direct labor hours have increased, the number of purchase orders have decreased, the number of part types have increased, the number of boards have increased, and the number of machine hours have also increased. Huh?
1,250,000.
This is 1,250,000?
That's it. What kind of addition have an impact in expected level of activity?
Yes, absolutely. So this is what we're anticipating. It's our forecast based on the economy, so the fact that we're in a recession, that there's new competitors in the market, all of those variables. That's the responsibility of management to make that type of assessment. What if I told you that the actual overhead incurred was $1,302,000? If the actual overhead is $1,302,000, and we said that the overhead applied is $1,288,000, then are we over-applied or under-applied? We know here that the difference is $14,000. Our actual overhead is $1,302,000. That's what I'm telling you that. The overhead that we applied is $1,288,000. So there's a difference between the actual overhead and the overhead that we apply. That's very common, that you're going to have some type of variance. It's going to be either favorable or unfavorable. Now, we don't want the variance to be generally too big. At first, you might think that's a good thing. Well, for that period, that's exciting, but the question is, why would the discrepancy be so big? That should be a red flag for us. We're not going to be perfect, right? We're making some assumptions, some estimates, and it's okay, it's not exact. We applied overhead of $1,288,000, but are we over-applied or under-applied? So in this case, the overhead is under-applied. Okay, so what that means is that we applied $1,288,000. Good. We applied that overhead. However, the actual overhead was more than that. So we under-applied by $14,000. If we had a crystal ball, we knew in advance that overhead was $1,302,000, we would have applied that. But we don't. We made some assumptions and some estimates about what we thought the costs were going to be, and we applied $1,288,000. But we were off by $14,000. So we under-applied. Now you say, well, now what? Well, then we have to make an entry in our books to adjust for that. Because remember, our books right now only show that $1,288,000. But that's not enough. We didn't capture all the costs. All the costs were unrecorded. So we have to make an adjusting entry for the $14,000. Questions? So even if you're not the one that's doing this analysis, what's important is to understand when somebody presents you with this information so that you can make decisions. But more than likely, as a manager or an executive, although you would have the support of people in the finance team and accountants, but you're going to need to make your own, you're going to need to do your own analysis and make some assumptions about what you anticipate sales, for example, might be, and what implications that's going to have for manufacturing overhead. Why is that important? Why do we need to know how much manufacturing overhead is going to be?
It's going to determine our cost. Sometimes it's going to determine our revenue.
Right, so that in some cases, the manufacturing overhead might go down because we achieve some economies of scale or some level of efficiency. And maybe in that case, at our discretion, maybe we might lower the price. Because maybe the customer is saying, let's say Target says, you know, we're considering carrying your product. And we're going to buy, on an annual basis, 10 million units. For most companies, 10 million units is substantial. But they say, your salesperson told us, your sales manager told us that we have to buy the product from you for $8.10. Well, we want to make 30 points and sell it at $10. That means that we want to buy it for $7. And you say, well, the price is $8.10. But they say, we're going to buy 10 million units. Say, go back and talk to Professor Bassell and see what kind of deal you could work out. So then what are we going to do is we need to find out what's going to happen to our manufacturing overhead and our other costs. Because now we're probably going to have to open up on the weekend to meet their demand. could mean overtime. That's something else. We're going to get to that too. That's an interesting computation. How we account for that. How we account for overtime in terms of the incremental cost versus the person's straight salary.
But always there is a risk because the product might not move, so basically it might impact us and that's cost too.
Absolutely, they may not sell the product for whatever reason. That's why we should resist generally giving a guaranteed sale. Retailers very often they ask for a guaranteed sale, which means that if you ship them for, let's say, for the holiday season, like for the fourth quarter of this year, you ship them 1 million units. They say that their expectation is that it's a guaranteed sale, which means that if they don't sell it, they send it back. Now, the last thing that you want, trust me on this, the last thing that you want is for anybody to send you back 1 million units of anything. All right? That is a major disaster because when you shipped it to them, it's on these nice pallets. They're all stacked up, neat, even, everything. When they send it back to you, all the cartons are ripped open. What they're sending you back is garbage. You'd have to put money into the product, more direct labor. Why? Because you're going to have to put it in new packaging, and now you're going to have to pay for not just for the laborers to repackage the product, but then you have to pay for the cardboard that the product is packaged in. So tell them, no, homie, don't play that. Say, no, we don't do direct. We don't do guaranteed sales. But if for some reason you do find yourself in that situation, the best thing is just to give them markdown money. Just tell them, well, we're not going to take back the product, but instead of selling it at selling it at $10, tell them to sell it at $8, so that they could sell through all the products. Yeah, give them the markdown money instead. That's the best thing to do. The problem with the guaranteed sale is it discourages them from doing their job as a retailer. So why would they make any effort to promote the product, to put it in their weekly flyer, to put up signs in the window, to put in-store displays of the product? If it doesn't sell, they're going to send it back to us anyway.
But why it's not written in the contract that you cannot return this product?
Well, do you have to agree with them that those terms, that either if it doesn't sell, you would give them markdown money, or maybe it's negotiated that if it doesn't sell, that's on them. You don't. But it's become very common. The retailers expect that. In fact, they take. Some retailers, especially big retailers, they automatically take a percentage for breakage. That means, or that the product is damaged. You say, but I sent you shirts, what do you mean they broke? They just take percentages off the invoice, anything. Just like they think that's, normally the idea is that, well, sometimes you ship something and it breaks. So you say, all right, no problem, I'll give you an allowance for that. Now they just think, well, that's just a given, we just take off 4%. Maybe they were 4%. What happened? What's the shirt? Did it break? No, but hey, they think that's part of their margin.
When you say markdown money, like they give you back markdown money, that's like what they give you, like a percentage of what the product is worth. If it's remains after like the season over.
Right. So they'll exactly. So you. The manufacturer might give you, let's say, $1 per unit. And so the reason why they give you that dollar is so that now you could sell the product that you used to sell at $10 at $9. And as a retailer, you're still making the same profit margin. If they want to sell it at $8, well, then they share the pain with you, because they're losing $1, you're also losing $1. And at a 20% price reduction, you would think that in an elastic market, in a price-sensitive market, that when the price goes down 20%, that the number of units sold is going to increase significantly.
Sometimes,
Oh boy.
sometimes like big companies like Coke and Pepsi, when they come out with new products with the competition, they offer the customer guarantee sale. I say if it doesn't move, we get it back. And it's safe.
Oh, absolutely, definitely. For if it's an innovative new product or a new flavor, you want to give your retailer or distributor an incentive. They don't want to take a chance. They think, oh, well, this is, who knows if it's going to sell. Even though you would think that when you go in to these retailers that you've done your research already, you tell them that you're going to back this launch with $30 million in advertising. You did taste tests and so on, but still, I can understand. You're right. There's a case where they're still apprehensive. They don't want to take a chance. So you whipped up some new flavor in your factory. We take it in our store, then maybe the customers don't buy it. Or maybe once they carry it, then you decide, well, we're not going to spend the $30 million on advertising anymore. Well, that was the reason they took it in the first place, was because they believed that there would be that demand. So absolutely, what Yusuf is saying is for a new product, retailers are going to be apprehensive. So in that case, you may need to give them some type of incentive, because otherwise they may not want to carry the product. So in that case, you may be forced to give them a guaranteed sale. So they're saying, well, if you have that much confidence in the viability of the product, then so guarantee the sale. If it doesn't sell, so you take it back. If it does sell, okay, then everybody's happy. Questions?
It's not like with like really highly desired products, right? That usually is sold at all. Let's say Procter & Gamble products, right? I mean, you know that people will buy a product on a regular basis, so let's say in Target. Therefore, most likely they won't do a guaranteed sale, right? They don't sell.
Well, in that case, Walmart probably wouldn't ask for a guaranteed sale, and maybe if Procter & Gamble is so confident, maybe they wouldn't mind giving a guaranteed sale. But again, the problem is that even though Procter & Gamble says, oh, there's no question, we know that that this product is going to sell very well, but you put yourself in a difficult situation when you guarantee the sale, because then what's the incentive for them? For the retailer, that is.
They make money off the sale, regardless, so
They know what's in it.
that should be like their main incentive. If
You
I
would
sell
think
this
so.
product, I'll get,
Right.
funds.
Right, you would think so. Yeah, definitely. I mean, I think with Walmart, I think they're responsible to do that. Other retailers, you know, generally like the retailers that are going to ask for the guaranteed sale are those that are having problems already. And so they're already struggling. And so that's why they don't want to be, they're even more concerned about being stuck with the product.
What determines like product is overpriced or like normal price or overpriced? For example, like I read on newspaper that cars right now in USA are overpriced. I don't know why the person, it's subjective idea. Cars are here in USA overpriced. I don't know why.
Oh, they said that the cars are overpriced?
Yeah. But I know I'm working in the car business right now. I know the cars in Europe is more overpriced than
Yep.
so it's more expensive. I don't know why that person.
I think the market itself determined that, and competition at the same time, because some people, some customers, are just loyal to them. They give us the prices, it's customer loyalty.
Right, absolutely. Like with some electronics, there's definitely an affinity. There's a relationship between the customer and the brand. Like for example, Harley-Davidson. these customers are very engaged. There's a very high level of engagement, which is difficult to do. If you ask people about a particular brand, it's usually very rare to say, I love that brand. But sometimes people say that about their brand. Like for like Harley Davidson, they might say that.
Yeah, I saw Range Rover and people love the brand.
Right, so, but it's difficult to reach that such a high level of involvement that you have that type of engagement. Like with Harley Davidson, for example, I know that they have on their website a blog where Harley owners go there and they talk amongst themselves about the motorcycles and the features and all that. Like, do people do that, you know, with their Hyundais? Right? Not as far as I know. But that's over time, you build that type of relationship. Look at Toyota, for example. Despite the challenges that they've had, you know, Toyota's, their secret to success is not that they're at a low price. Often there's a tendency for us to think, well, Toyota dominates the US car market. They've been able to successfully penetrate the US car market. And we think, oh, it's because they're at a lower price. It's a Japanese car, it's at a lower price. No, actually, it's not at a lower price. It's significantly more expensive than a Chrysler vehicle, for example. Now, not all Toyotas are made in Japan. At one time, they were. It's actually only fairly recently, like in the last 5 to 10 years or so, that they've even started making or assembling Toyotas in the U.S. But for a long time, they were made in Japan. Now, to ship a car from Detroit, when you go into the dealer to look at a Chrysler or a Ford, it says right on the window, the sticker in the window of the car, it says how much the transportation cost is. And it says $650, sometimes it says $750. That's the cost to ship the car from Detroit, right? Everybody, that's in Michigan, right?
Yep.
We're in New York. If it costs $750 to ship the car from New York, from Michigan to New York, how much do you think it costs to ship a car from Japan?
A lot of money.
But they don't, who do you think pays that cost?
Customer.
It's basically, it comes down to the customer. And so when you factor in the fact that you have the transportation cost, but then again, nowadays it's not as significant because a lot of them are assembled in the US, but still, that certainly transportation is a significant consideration and impacts the price and the quality of the car. And some of that is a little bit of smoke and mirrors. It's the idea that people perceive that the quality is very high.